When you look at your paycheck, you probably think about what you owe. The mortgage, the car payment, maybe some credit cards. But have you ever stopped to think about what the entire world owes? Because here's a number that should keep you awake at night. Global debt just hit $250 trillion. That's not a typo. 250 trillion. To put that in perspective, if you spend $1 million every single day, it would take you over 680,000 years to spend that much money. And here's the part that breaks most people's brains. Every major country on Earth is drowning in this debt. The United States owes over $30 trillion. China owes $16 trillion. Japan owes $12 trillion. Germany, the UK, France, Italy, they're all buried under mountains of IOUs that grow bigger every year. But if everyone owes money, who exactly is getting paid? If every government is a borrower, who are the lenders? The answer isn't what most people think, and it reveals something deeply unsettling about how our entire financial system actually works, because the creditors aren't who you'd expect. And the game being played is far more dangerous than anyone wants to admit. Most people imagine debt the way they understand their own finances. You borrow money from a bank, you owe the bank, you pay the bank back. Simple. But when entire nations borrow trillions, the mechanics become something else entirely. Government debt isn't held by some mysterious foreign overlord counting gold coins in a vault. It's held by a web of institutions, funds, and entities that most people have never heard of, but that control more wealth than entire countries. Let's start with the biggest piece of the puzzle, pension funds. Right now, pension funds around the world manage roughly $35 trillion in assets. That's more than the entire gross domestic product of the United States. These funds represent the retirement savings of hundreds of millions of workers. Teachers, firefighters, factory workers, office employees. Every month, money gets deducted from paychecks and flows into these massive pools of capital. And where do pension funds put that money? A huge chunk goes straight into government bonds. When the United States issues new debt, pension funds buy it. When Germany sells bonds, pension funds buy those too. The same pattern repeats across every developed economy. So, when politicians talk about the national debt, they're often talking about money owed to the retirement funds of their own citizens. The government borrows from the future savings of its people to pay for today's spending. It's a circle that most voters never see, but it explains why debt keeps growing. Politicians can spend money without raising taxes because they're borrowing from pensions that won't need the money back for decades. The bill gets pushed into the future when today's workers become tomorrow's retirees. But pension funds are just the beginning. Insurance companies form another massive category of creditors. These companies collect premiums from millions of policyholders and need to invest that money somewhere safe and reliable. Government bonds fit the bill perfectly. They're considered risk-free investments backed by the full faith and credit of entire nations. Insurance companies hold trillions of dollars in government debt across the globe. When you pay your car insurance or life insurance premium, a portion of that money eventually flows into government bonds. You become an indirect creditor to your own government without even knowing it. Then there are the banks. Not the small community banks that most people think of, but the massive financial institutions that move money around the global economy. These banks don't just lend to individuals and businesses. They're some of the largest holders of government debt in the world. In Europe, banks are required to hold government bonds as part of their capital reserves. It's considered safe, liquid, and profitable. But here's where it gets twisted. These same banks often borrow money from their own central banks at low interest rates, then use that money to buy government bonds at higher rates. They profit from the spread while governments get deeper into debt. The most surreal part of this system involves central banks themselves. The Federal Reserve, the European Central Bank, the Bank of Japan, these institutions have become some of the largest creditors to their own governments. How does that work? It's simple and insane at the same time. Central banks create money out of thin air, then use that newly created money to buy government bonds. It's called quantitative easing, but it's really just a fancy term for printing money to buy debt. In Japan, this has reached almost comedic proportions. The Bank of Japan now owns over 40% of all Japanese government bonds. Think about that. The Japanese government owes money to itself. It issues bonds, its own central bank creates money to buy those bonds, and the interest payments flow in a circle from one government institution to another. It's financial theater, but the debt is treated as real, the interest payments are real, and the economic effects are real. The United States isn't far behind. During the financial crisis of 2008, and again during the pandemic, the Federal Reserve bought trillions of dollars worth of government bonds. At one point, the Fed was purchasing more than half of all newly issued government debt. The government spends money it doesn't have, issues bonds to cover the spending, and its own central bank creates money to buy those bonds. It's a perpetual motion machine of debt and money creation. But here's where foreign creditors enter the picture. And this is where geopolitics gets messy. Countries don't just owe money to their own institutions. They owe massive amounts to foreign governments, banks, and investors. Japan holds over $1 trillion in United States Treasury bonds. China holds over $700 billion. These aren't small numbers. They represent real leverage, real economic power, and real geopolitical influence. When China buys American government bonds, it's not doing it out of friendship. It's parking the dollars it earns from trade surpluses, but it's also gaining influence. If China decided to dump its treasury holdings, it could send shockwaves through American financial markets. The same dynamic plays out everywhere. Germany holds Italian bonds, Saudi Arabia holds British bonds, and the web of cross-border debt creates a financial system where everyone owes money to everyone else. This creates what economists call financial interdependence, but what really should be called mutual assured economic destruction. No major country can allow another major country to default, because the financial contagion would spread everywhere. The creditors and debtors are so intertwined that collapse anywhere means collapse everywhere. It's not stability. It's fragility disguised as stability. And then there's the strangest creditor category of all, ordinary people who don't even know they're creditors. Mutual funds, exchange-traded funds, and retirement accounts are stuffed with government bonds. When someone buys an index fund or puts money into a retirement account, a portion of that money flows into government debt. Millions of people who worry about their country's debt crisis are actually funding that very crisis through their own savings and investments. The system has created a feedback loop where governments can borrow endlessly because the money always finds its way back to them. Pension funds need safe investments, so they buy government bonds. Insurance companies need reliable returns, so they buy government bonds. Banks need liquid assets, so they buy government bonds. And central banks can always create more money to buy government bonds when private demand falls short. But this raises a terrifying question. What happens when the music stops? What happens when creditors lose confidence? When pension funds need their money back? When foreign governments decide to sell rather than buy? The answer is what we've seen throughout history whenever debt systems collapse. The creditors get paid first and everyone else gets crushed. The mechanics of who gets paid and who gets crushed follow patterns that have repeated for centuries. When governments can't service their debts, they don't treat all creditors equally. There's a hierarchy, an unspoken pecking order that determines who survives and who gets wiped out. At the top of this pyramid sit the central banks and major institutional investors. These entities have political connections, lobbying power, and the ability to move markets. When crisis hits, they get bailed out, rescued, or made whole through emergency programs that ordinary citizens never see coming. Below them are the foreign sovereign creditors, the countries that hold massive chunks of other nations' debt. These creditors wield geopolitical leverage. When Argentina defaulted in 2001, it wasn't pension funds in Buenos Aires that forced the government into brutal austerity measures. It was foreign bondholders and international institutions that demanded their money back. The same pattern played out in Greece, where German and French banks holding Greek debt pushed for bailouts that ultimately benefited the creditors more than the Greek people. At the bottom of this hierarchy sit individual savers, small pension holders, and retail investors. When the system cracks, these are the people who discover their government bonds aren't as safe as advertised. Their savings get inflated away, their pensions get restructured, and their retirements disappear into the mathematical black hole of unpayable debt. History shows us this pattern again and again, from Weimar Germany to modern Lebanon, where bank depositors woke up to find their accounts frozen and their life savings converted into worthless local currency at government-dictated exchange rates. But here's what makes the current system uniquely dangerous. The scale is unprecedented, and the creditor web is more tangled than ever before. When Rome debased its currency, the damage was mostly contained to the Roman Empire. When individual countries defaulted in the past, the pain was mostly local. Today's debt system is global, interconnected, and so large that no single institution or country can unwind it safely. Consider the derivatives market, where financial institutions bet on the direction of government bond prices. This market is worth over $500 trillion in notional value. That's twice the size of global debt itself. Banks, hedge funds, and investment firms have created complex financial instruments that multiply their exposure to government debt by factors of 10, 20, or even higher. When government bond prices move, the effects ripple through derivative contracts, margin calls, and counterparty obligations that span the globe. The creditor network isn't just banks and pension funds anymore. It includes shadow banks, private equity firms, sovereign wealth funds, and family offices managing the wealth of billionaires. These entities operate outside traditional banking regulations, but they hold trillions in government debt and debt-related securities. When crisis strikes, they can move money faster and with fewer restrictions than traditional institutions. They become the smart money that gets out first, leaving slower-moving creditors holding the bag. Sovereign wealth funds represent another layer of this creditor puzzle. Countries like Norway, Saudi Arabia, and Singapore have amassed trillion-dollar pools of capital that they invest globally. These funds buy government bonds from other countries, creating a system where oil revenues from the Middle East help finance government spending in Europe and North America. The Norwegian Government Pension Fund owns over $1 trillion in global assets, much of it in government securities. When oil prices fluctuate, when geopolitical tensions rise, or when domestic priorities change, these massive funds can shift their holdings, sending waves through global bond markets. The insurance industry adds another dimension to this creditor maze. Life insurance companies, health insurers, and property insurers collect premiums and invest them in government bonds to match their long-term liabilities. But insurance isn't just a domestic business anymore. European insurers hold American government debt, Japanese insurers hold European bonds, and the cross-border insurance industry has created another layer of international creditor relationships. When natural disasters strike, when pandemics hit, or when insurance claims surge, these companies need to liquidate assets quickly. Government bonds are supposed to be the safe, liquid assets they can sell easily. But what happens when everyone tries to sell at once? Money market funds represent perhaps the most fragile link in this creditor chain. These funds promise investors that they can withdraw their money at any time while earning slightly higher returns than bank accounts. To deliver on that promise, money market funds invest in short-term government securities, corporate bonds, and bank deposits. Trillions of dollars flow through these funds, representing the cash holdings of corporations, municipalities, and wealthy individuals. But money market funds operate on the assumption that not everyone will want their money back at the same time. When that assumption breaks down, as it did briefly in 2020, the entire short-term funding market can freeze up, forcing central banks to step in as lenders of last resort. The corporate sector has become an unwitting participant in this creditor network through their treasury operations. Large corporations hold billions in cash reserves, and they invest those reserves in government bonds and money market funds. Apple, Microsoft, Google, and other tech giants are sitting on hundreds of billions in cash, much of it invested in government securities. When these companies need cash for operations, acquisitions, or shareholder returns, they sell government bonds. Their decisions about cash management can influence government bond markets just as much as traditional financial institutions. Exchange-traded funds have democratized access to government bond markets while creating new forms of systemic risk. ETFs that track government bond indices hold hundreds of billions in sovereign debt, allowing ordinary investors to buy and sell government bonds as easily as stocks. But ETFs create a mismatch between the liquidity they promise investors and the actual liquidity of the underlying bonds. Investors can sell ETF shares instantly, but the fund managers can't always sell the government bonds quickly enough to meet redemption demands. This mismatch has the potential to amplify selling pressure during market stress, turning orderly markets into panicked routes. The repo market, where financial institutions lend money to each other using government bonds as collateral, has become the plumbing of the modern financial system. Trillions of dollars change hands every day in repo markets, with government bonds serving as the oil that keeps the machine running smoothly. Banks, hedge funds, money market funds, and corporations all participate in repo markets, creating a web of overnight lending relationships backed by sovereign debt. When repo markets malfunction, as they did in September 2019, the effects ripple through the entire financial system, forcing central banks to inject hundreds of billions to keep the markets functioning. All of these creditor relationships have created a system where government debt isn't just an economic issue. It's become the foundation of the entire global financial architecture. Every major financial institution, every pension fund, every insurance company, and every investment fund depends on government bonds as the bedrock of safety and liquidity. The system works as long as everyone believes government debt is risk-free and will always be repaid. But belief systems can change quickly, and when they do, the creditors who seemed so powerful become desperate sellers in a market with no buyers. A market with no buyers. The most chilling aspect of this creditor web is how quickly it can reverse. Throughout history, the transition from creditor confidence to creditor panic has happened not over years but over days or even hours. When creditors start questioning whether they'll be repaid, the selling begins. And when the selling begins, prices collapse. which makes other creditors nervous, which triggers more selling. It's a feedback loop that can destroy decades of accumulated debt relationships in a matter of weeks. Consider what happened in the European debt crisis of 2010. For years, German and French banks had loaded up on Greek, Italian, Spanish, and Portuguese government bonds, treating them as virtually identical to German bonds. The yields were slightly higher, the risk seemed minimal, and the profits were steady. European Monetary Union had created the illusion that all European government debt was equally safe. Then reality intruded. When Greek finances unraveled, it wasn't just Greece that suffered. Every bank, pension fund, and insurance company holding Greek bonds faced massive losses. But the contagion spread beyond Greece. Investors started questioning whether Spanish bonds were safe, whether Italian debt was sustainable, whether Portugal could pay its bills. The selling pressure moved from country to country like a financial plague, and suddenly creditors who had been earning steady returns were facing catastrophic losses. The European Central Bank had to step in with unprecedented measures, buying hundreds of billions in government bonds to stabilize markets. But here's the crucial point. The ECB wasn't buying bonds to help governments. It was buying bonds to save the creditors. The banks, insurance companies, and pension funds holding European debt were too important to fail. So the central bank essentially socialized their losses by creating money to buy the bonds they needed to sell. This pattern reveals something fundamental about how the creditor system actually works. When things go well, creditors earn profits from government debt. When things go badly, central banks step in to protect creditors by printing money and buying bonds. The profits are private, but the losses get absorbed by the entire monetary system through inflation, currency debasement, and the erosion of purchasing power for ordinary citizens. The Bank of Japan has taken this dynamic to its logical extreme. Facing decades of economic stagnation and an aging population, Japan has run massive government deficits while maintaining artificially low interest rates. The result is a debt-to-GDP ratio that exceeds 250%, levels that would have triggered crisis in any other country. But crisis hasn't come, because the Bank of Japan simply creates money to buy whatever government bonds private creditors don't want. This arrangement has created a bizarre financial ecosystem where the Japanese government can borrow almost unlimited amounts because its own central bank stands ready to monetize any debt that private creditors won't buy. Private creditors still participate in the market, earning modest returns while the central bank provides an implicit backstop. It's a system that works until it doesn't, and when it stops working, the adjustment will be violent. The United States is following a similar path, though the dynamics are different. American government debt is still seen as the safest asset in the world, the ultimate store of value during times of crisis. When markets panic, money flows into US Treasury bonds, not away from them. This gives the United States what economists call exorbitant privilege, the ability to borrow in its own currency without facing the same constraints as other countries. But even this privilege has limits, and those limits are being tested. The Federal Reserve now owns more than $5 trillion in government bonds, purchased through successive rounds of quantitative easing. Foreign creditors still hold massive amounts of American debt, but their appetite isn't unlimited. China has been reducing its treasury holdings, not dramatically, but consistently. Other foreign creditors are diversifying into gold, commodities, and alternative currencies. The foundation of American debt credibility is slowly shifting. What makes this particularly dangerous is the role of algorithmic trading and passive investment strategies in government bond markets. Trillions of dollars are now managed by computer algorithms that buy and sell based on mathematical models, not human judgment. These algorithms assume that government bonds will always have liquid markets, that there will always be buyers when they need to sell. But algorithms can all reach the same conclusions simultaneously, creating selling pressure that overwhelms market capacity. Passive investment strategies have funneled enormous amounts of money into government bond index funds and ETFs. These funds don't make active decisions about which government bonds to buy or sell. They simply track indices, buying more bonds when money flows in and selling when money flows out. This creates a mechanical relationship between investor sentiment and government bond demand that operates independently of any analysis of creditworthiness or fiscal sustainability. The growth of passive investing means that government bond markets are increasingly driven by flows rather than fundamentals. When investors are optimistic and putting money into bond funds, governments benefit from artificial demand for their debt. When sentiment turns negative and investors withdraw money from bond funds, governments face selling pressure that has nothing to do with their actual fiscal situation. The creditor base has become more mechanical and potentially more volatile. High-frequency trading has added another layer of complexity to government bond markets. These trading firms use sophisticated algorithms and ultra-fast connections to profit from tiny price movements that occur over milliseconds. They provide liquidity when markets are calm, but they can disappear instantly when volatility rises. Government bond markets that appear deep and liquid can become thin and treacherous without warning, as high-frequency traders shut down their systems and wait for stability to return. The rise of environmental, social, and governance investing has created new dynamics in the government bond creditor base. ESG-focused investors are beginning to evaluate government debt not just on financial returns, but on whether governments meet certain environmental and social criteria. This could create situations where governments face higher borrowing costs, not because of fiscal problems, but because investors disapprove of their policies on climate change, social inequality, or governance standards. Cryptocurrency and digital assets have begun to create alternative creditor relationships that exist outside traditional government bond markets. While still relatively small, the growth of decentralized finance and digital currencies represents a potential challenge to the monopoly that government bonds have long held as the ultimate safe asset. If alternative stores of value gain credibility, it could reduce demand for government debt from creditors seeking safety and liquidity. The demographics of creditor institutions are also shifting in ways that could destabilize government bond markets. Pension funds in developed countries are beginning to face the reality of aging populations and increased benefit payments. Instead of being net buyers of government bonds, many pension systems will need to become net sellers over the coming decades as retirees draw down their benefits. This demographic shift could fundamentally alter the supply and demand dynamics that have supported government debt markets for generations. Insurance companies are facing similar pressures as life expectancies increase and investment returns remain low. The business model of collecting premiums today and investing them for decades before paying claims is becoming more challenging when safe government bonds yield close to zero after inflation. Some insurance companies are being forced to take more risk in their investment portfolios, potentially reducing their demand for government bonds. The creditor web that supports global government debt is more complex, more interconnected, and more fragile than most people realize. It's not just banks and governments anymore. It's algorithms and passive funds, high-frequency traders and ESG investors, pension systems and insurance companies, all bound together in relationships that can shift from cooperation to competition without warning. And when those relationships shift, the consequences won't be limited to financial markets. They'll reshape the economic reality for billions of people who never knew they were part of this vast creditor network in the first place. The fragility of this creditor system becomes clear when you examine what happens during actual sovereign debt crises. Take Argentina, a country that has defaulted on its debt 9 times in its history. Each time the pattern is the same. First, creditors pile in during good times, convinced that government bonds offer safe returns with attractive yields. International banks, pension funds, and hedge funds load up on Argentine debt, treating it as just another emerging market investment opportunity. Then reality hits. Economic mismanagement, political instability, or external shocks make it impossible for the government to service its debts. The creditors who were so eager to lend suddenly become desperate to get out. But there's a problem. When everyone wants to sell and no one wants to buy, prices collapse. What seemed like a liquid, tradable asset becomes worthless paper overnight. The creditors don't just lose money quietly, they fight back through the legal system, hiring armies of lawyers to pursue the government through international courts. Vulture funds buy up defaulted bonds at pennies on the dollar, then spend years in litigation trying to force full repayment. These funds have seized Argentine naval vessels, frozen government bank accounts, and prevented the country from accessing international capital markets for decades. But here's what's truly disturbing about these sovereign defaults. The creditors often come out ahead in the long run. After years of legal battles and economic chaos, governments usually settle with bondholders for a fraction of the original debt. The creditors who bought bonds at distressed prices can make enormous profits, while the ordinary citizens of the defaulting country suffer through years of austerity, unemployment, and economic hardship. This dynamic creates a moral hazard that infects the entire system. Creditors know that governments rarely let them lose everything, so they're willing to lend to increasingly risky borrowers at relatively low interest rates. The implicit guarantee that taxpayers will ultimately bear the cost of any losses makes creditors more reckless, not more careful. They pile into government debt during good times, then demand bailouts during bad times. The Lebanon crisis that unfolded starting in 2019 offers a perfect case study of how modern creditor relationships can turn predatory. Lebanese banks had operated what was essentially a Ponzi scheme for decades, offering high interest rates on deposits to attract money from Lebanese expatriates and wealthy Arabs. The banks then used those deposits to buy Lebanese government bonds, which offered even higher yields. The system worked as long as new money kept flowing in to pay the interest on existing deposits. But when economic pressures mounted and depositors started demanding their money back, the banks couldn't pay. They had lent most of their deposits to a government that was itself bankrupt. The result was a complete collapse of the banking system, with ordinary depositors losing their life savings, while bank shareholders and bondholders were protected. The creditor hierarchy became brutally clear. International bondholders continued to receive payments, even as local depositors were locked out of their accounts. The government prioritized foreign creditors over its own citizens, because defaulting on international bonds would have meant complete exclusion from global capital markets. Lebanese families watched their savings evaporate, while Swiss banks and European investment funds collected their interest payments on schedule. This pattern isn't unique to developing countries. During the 2008 financial crisis, creditors to major banks like Lehman Brothers, Bear Stearns, and AIG discovered that not all creditors are created equal. Senior bondholders were protected, shareholders were wiped out, but the most devastating losses fell on pension funds, insurance companies, and money market funds that had trusted these institutions with their capital. So here's the truth they don't want you to understand. You are both the creditor and the victim in this vast financial theatre. Your pension fund owns the government debt that your taxes will have to service. Your insurance premiums buy the bonds that your children will inherit as obligations. Your savings account sits in a bank that lends your deposits to a government that borrows against your future. And when this system finally breaks, as all debt systems eventually do, you'll discover that being a creditor means nothing when the entire game is rigged against you. The house always wins, and you were never really playing. You were always just paying.